What's up, investors? Another video today. This one, again, coming from a comment left on one of my videos. Really appreciate it. We're going to go over GameStop Corporation, ticker symbol GME. Okay, here we go. GameStop. I'm actually really excited to do this because, the last couple earnings reports that I've done, we've looked at Microsoft, we've looked at Apple, we've looked at Tesla, we've looked at Facebook, and quite frankly, these are some of the world's best companies and some of the richest companies. And it's almost like trying to figure out who's hotter between Natalie Portman and Anna Kendrick. So, you're almost splitting hairs when you're getting to that elite level company. Whereas GameStop, first, let's take a look. Let's take a step back. Look at the stock chart. Here's a 5-year view of GameStop here, ticker symbol GME. Look at this trend. Okay, I mean, it doesn't take a finance degree to see what the long-term trend of this stock has been, and it has been down and down very steady. This is like a ski slope down this mountain here. So to think as an investor you're going to come in here and pick a bottom and watch the stock rally up and reverse this trend would be very difficult. Now we do see some flattening here, and if you want to get into technical analysis and things like that, you certainly could. But if you're a long-term investor, just notice that this trend is negative and it's been down. And let's jump into kind of the financials to see if we see any evidence of this company being able to turn things around. Now, obviously, retail has been under pressure. The video game sector, which this company plays in, has been under pressure. This company's probably been mismanaged and the like, but let's jump in the financials and see what's going on. So we got net sales here. Notice, again, down. So stock price down. Tesla, Facebook, Microsoft, these companies, their earnings are down. And so that's why their stock charts don't look like this. So earnings down considerably here. Okay, this is quite a move year over year. This is not a small amount, of losses here. Cost of sales trending down. That's given that the sales are trending down, the cost of sales are trending down as well. We've got gross profit here. You could bust out your calculator and figure out the margin there, but it's not particularly great. We just looked at Microsoft and it was much healthier than this, at least from a gross profit perspective. Selling, general, and administrative expenses coming in line, so somewhat similar. Even though you have this massive drop, they haven't been able to cut this that much, so that's somewhat disappointing. We have some goodwill impairments. Look like they were didn't happen this year. This is usually related to some kind of business that they might have bought in the past or some kind of asset that they had in the past, and it's been written down. The asset isn't performing as well or whatnot. We again have asset impairments here as well. Smaller charges here, much bigger charge here. So you see they did probably some restructuring back in 2019 that led to this massive operating loss here of again, this is in millions, so we're adding a lot of zeros here. This is a massive loss on this much in sales. So I turned it around this year, mainly due to not having this impairment charge reoccur in 2020. So it's this is not a company that's bleeding lots of money, at least in 2020. But like I said, we saw the top line decrease very rapidly in 2020, and you'd sure like to see this trend kind of flatten out and go back up before maybe I'd want to jump in and buy shares of this. We've got some other minor costs here. We've got some earnings. We got some interest tax expense. Whoa, that seems like pretty high interest tax income tax when you're only paying when you're only made 75.2 million. So I don't know what's going on there. So we have a net income here, not too bad. Again, that comes off the heels of a big decline on net income, mainly due to this impairment charge here, or this goodwill charge there. And so coming down, we have the final kind of net income here from this is continuing operations. This is like a a gap accepted net income. So, hey, look, they turned it around at least from a net income perspective. Now you'd like to see, the bottom line has turned around, it appears. Now you'd like to see this top line. I think once this top line stabilizes and then maybe shows some evidence of maybe going back up, I think that's, to me, would signal that would be a turning point for the stock. Now, you could come in here and do technical analysis and maybe figure something else out. But for me, from a fundamental perspective, it looks to me that net income might be turning the corner. Now you'd like to see this top line number do the same. Earnings per share have gone over in other videos. I don't really pay too much attention to this because take a look at what we're doing here. Here's the weighted average common shares. I usually look at the diluted number. Look what it went to. They must have bought back or retired a lot of stock. Almost half the stock has been likely maybe some form of buyback here. And so that's going to drive up this earnings per share number, even when, maybe net income isn't particularly impressive. So what I like to do is look at net income, look at top line, look at what's going on with the share count. That's going to lead you to, essentially an EPS figure that you can kind of, devise on your own. Now they've got percentage. So now here we got a gross margin percentage here, and it did tick up. So gross margins are up. That's not bad. We do have this expense ticking up. This was 13. This impairment charge was 13% of revenues, and so that's obviously gone away. So that's helped. And we've kind of come down to a net income. It's very thin. Okay, this is a thin, razor thin margin on the bottom line here, because you have all these, charges and costs kind of coming out of the business after you hit that gross margin number. So this is not, again, not a business I'd be jumping up and down to invest in a 1% margin. I mean, chances are, there's small businesses in your neighborhood that can pull that off better than this company can. So net sales here, now we're looking at, notice this is like a 1 year, 52 weeks is a 1 year time frame. So up above was like a 3 month or a 13-week time frame. And now they're giving it 2 in a year. So you can kind of see the trend over a larger period of time. This is something you definitely want to do. I'll kind of speed through this. But again, we see net sales kind of declining here. We see, let's just jump down to this net loss. Notice over a year's time, they had a pretty good quarter, actually. GameStop actually had a relatively decent quarter, churning out this 21 million net income. But notice over a 1 year period, you're kind of hitting, it's still, the business is still not firing on all cylinders. Now, some of these impairment charges are included here, but you also have them in the year before as well. So this is something that's reoccurring, and until these charges really start to drop off, which we did see here in this quarter, whether or not that's going to continue or not, that's something you might want to research before jumping in here. Dividends per common share, so they are paying out some straight cash, and so that's kind of nice. And again, we see, from a margin perspective, year over year, it is ticking up, but this net loss is still worrisome. You're running at 8% last year, and it's still 7.3 this year. That has not turned the corner. Okay, so revenues are declining, and this net loss is staying the same. So it's not a very attractive business from that sense. Now let's come to the balance sheet, because as we see, this is a company that's losing money, and at least on a year over year basis, as you can see here, losing money per share here, net loss here, net loss here. So this is a company that's shedding cash and shedding investors as well, if you look at their stock chart. So let's take a look at the balance sheet, see what they've got on hand, and it's not necessarily a pretty sight here. Looks like what time frame we've got, February 2nd to February 1st, so a year's time frame on the balance sheet as well. Again, this is in millions. So had a fairly healthy $1.6 billion in cash there. Now we're down to 500 million. So boy, they've shed out a lot of cash over the last year or so. Receivables about the same. Inventory, this is probably a positive sign. If you're not growing sales, you want to have a tighter control over your inventory, and they have reduced this a noticeable amount. This is actually what I would consider some people might not think this is a positive. I think it's a positive that they've shed this inventory here, and maybe doing a better job managing with what they've got. We've got some prepaid expenses. Those look about the same. And we have assets held for sale. Look like maybe they're trying to sell something. And this is the money that's maybe due to them or coming to them. So moving on, here's total assets. Notice, look at this. I mean, we went from 4 billion down to 2.8 billion. That is a material decline. Okay, if it went from 4 billion to 3.8, it wouldn't really be that big of a deal, honestly, but this is a material decline here. Current liabilities, let's see how they're doing here. So we had more accounts payable here, so maybe that's where some of the cash went. That's not that would not be a terrible thing. We have some accrued liabilities here that has ticked down as well. This has ticked up, it looks like. Maybe these operating leases and stuff, maybe they weren't due last year. Current portion of debt, looks like maybe they've paid some of that off, or that maybe it just switched to long-term debt. That's possible as well. So total current liabilities, this is a red flag. Total current liabilities. These are liabilities that are due usually within the next 12 months. We've got $1.2 billion over here, and we have $499 million in the banks. Let's just treat these numbers at face value. Don't even add the zeros. Okay, if you owed like your landlord and your car company $1,200 and you had $500 in your bank account, you probably would be trying to look for some ways to raise some money. And so that's the situation that GameStop is in. So that was current liabilities. These are long-term. So look at long-term debt is 419 billion. That has ticked down. That's a positive. But again, we barely have enough cash on hand to cover this long-term debt. That is a scary thing, because if any kind of insolvency, then these guys get paid first, and then common shareholders basically get left with pennies on the dollar, if anything. Other long-term, we got an operating lease here. You have to lease. This is a company that operates thousands of storefronts. They have to have this as part of the business. Not necessarily something a negative, but it is something to keep in mind. Look at this. This is a big number. So other long-term liabilities, not too dire. But anyways, so here we go. Total liabilities. We're at total liabilities $2.8 billion. Actually, that's with shareholder equity. If you look at it here, it says $2.2 billion. And again, we have $499 million in cash. That's a little bit of a problem. We have some inventory, but as if you analyze GameStop's inventory, you can probably take this at a fraction. I mean, you can come here and just look at total assets here, or total current assets. We got 1.6 billion of that, and we've got $2.8 billion in liabilities. That's a problem. And it's definitely, there's a reason why the stock chart looks like this. And that's really the point of this video. Some of you might see a stock chart like this and be a fan of this company, or think, hey, they're going to be able to turn it around, or maybe you work for them or whatever. Well, I'm just showing you right here, guys, the numbers do not lie. This is not a pretty situation. If you want to see a pretty situation, look at the Microsoft video I did. Look at the Apple video I just did. Look at the Facebook video I just did. That's a far, far much prettier picture here. This is actually pretty grim looking, at least on the surface here. Net loss, again, this is going to be a cash flow statement. It's going to show you how cash is flowing through this balance sheet. Might not be, actually, this is kind of an exercise that might be worth it on a company like GameStop, because we have this large net loss here, but we've got some things in here like these impairment charges. You've got some other ones in here. Looks like merchandise and inventories. So you can kind of see, cash is not, here's our net loss here for a year, and here's net cash flows here. Well, it's still pretty bad. honestly, there's really no dressing this up. This is a pretty dire situation. Here over here it's a little bit different. You have a negative net loss here, but you have positive net cash flows. Here it's negative, and it's still very much negative on the cash flow basis. It's not good, honestly. It's really not good. Cash flows from investing activities, things are flowing. Cash is flowing out of the business here. From a cash flows from financing perspective, cash is flowing out of the business, but they are repaying some senior notes here. They're buying back shares. I don't know if that's a particularly great idea when you don't have a lot of cash on the balance sheet. Paying dividends as well. Does this company really need to pay a dividend? I don't know. It's certainly, buybacks and dividends can help a stock. Has it helped GameStop stock? Like, look at this chart, guys. Had these buybacks and this dividend, has this helped the chart? Absolutely not. So this is obviously something investors don't give a hoot about. So, maybe it would be wise for management to change their decision on this because, again, it's not helping the stock. So, moving on, see, we have cash. Look, we have cash and cash equivalents at the end of the period, and look at how it just bled out of the company. That is a problem. Now we got a sales mix here. This might give you a better idea. Like, hey, is there something? Is there a part of the business that is ticking up? So we've got, here's 13 weeks ended. This is on a quarter basis. And here's 13 weeks ended the prior year. This is 2020 here. And we got hardware and accessories down. Okay, now, if you're familiar with the game, the hardware cycle, I think Xbox and Sony have a new system coming out, and the current Xbox and the current PlayStation are kind of long in the tooth. So this might not be that alarming, and you could bet maybe that the new Xbox and the new PlayStation will help reverse this trend, although you can buy those at Best Buy. You could buy them on Amazon, or you could probably buy them directly from those respected companies as well. But I can imagine the next cycle of console that comes out that will help these numbers a little bit. Software, though, that is a problem. We're seeing this tick down. And collectibles, they made a really stupid purchase of GeekNet. That was another public company where they just kind of sold knickknacks and things like that. That is also down as well. That's not surprising. That wasn't a very good business. Probably a bad acquisition on their part as well. And again, we see net sales here trending down for that 13-week period. Now we get it here on a year-over-year basis, so you kind of get a broader perspective of what's going on. Again, hardware sales trending down heavily there. That's a big decline there. That's almost $1 billion. Software, not as bad on the year-to-year. So, hey, look, video games can be lumpy. They tend to maybe put out the good ones towards Christmas, and this period up here doesn't cover Christmas, and so that's why it helps looking at a larger period, not draw tons of conclusions here. You can look at it here and say, hey, well, it's declining, but it's not, again, it's about the same percentage of overall business, so it's not that bad. And then actually we see collectibles here trending up, so that's probably the holiday or the fourth quarter there ticking in, but this is a pretty minor part of the business there. Here's some non-GAAP results. So they're trying to, spin things in a little bit different way. Honestly, I'd ignore that because, the numbers don't lie, at least at least from the stock chart perspective and the top and bottom line. It doesn't look very good, at least from where I'm sitting right now. And folks, that about wraps it up. Hey, if you've got a company you want me to take a look at, leave me a comment below. You got any questions or any comments yourself about GameStop? Leave me a comment. I'd love to hear from you. Hit that subscribe button, hit that like button, and maybe consider sharing this video if it was something you'd like. Check out the rest of my videos on the channel if you have time. Thanks again, guys. We'll see you soon.